Dice de volatilidad, que sobre todo ha venido a raíz del dato de vacantes de empleo. Vamos a preguntarle por ello a Jay Pelosky, founder at TPW Advisory. Jay, good afternoon, good morning for you.
Thanks, Marta. Nice to speak with you.
Jay, stock market is plunging now after JOLTS data. What do you think this is, the sharp reaction in the market?
Yes, it has been a rough slog for investors who are long equities, as we are at TPW Advisory. The last couple of weeks, the last couple of days, the last couple of months, it's all been kind of one way, which is the reversal of what the first part of the year was. And look, I think there are two things going on. One, the stock market is looking for good economic news to validate the strong earnings growth or good earnings growth that's expected for the rest of this year and 2024. And that good data is coming in. We had the ISM manufacturing data yesterday that was significantly better than expected. And we expect the ISM manufacturing data to break back above 50, where it hasn't been for several years, in the coming months. And then today, as you note, the JOLTS data suggests there are many more job openings, suggesting a continued strong economy. So that's usually good for stocks. The problem is that the bond market is falling apart and has had to go very quickly from expecting a recession in 2024 before the Fed meeting several weeks ago to now pricing in a solid economic recovery or outlook for the United States. And as that has happened, rates have backed up very, very quickly. You now have a situation where the Treasury market is very oversold. You have a situation where speculators are net short, the most aggressive net short position in about 15 years in the Treasury market, and you have no buyers. So every day it moves 7-10 basis points, and that freaks out the equity holders, and so they sell a little bit too. And what you have is obviously a market environment where the only thing that's actually working, if you're a long investor, is the commodity space up until this point. In Q3, commodities were the only asset class that had a positive return, and energy was the only sector in the S&P. Out of the 11 sectors, energy was the only sector with a positive Q3 return. So I think it's a little bit of good news, bad news, and a dislocated bond market. The good news for long investors is that we're about to go into earnings season for Q3. We think it's going to be a pretty solid earnings season. We think the outlook is going to be pretty solid, and that's really what equity investors, at least once bonds stabilize, equity investors are going to be focused on what does 2024 really look like. And the good news is after the selling of the last couple of weeks, stocks are much cheaper than they were a month ago, 2 months ago, 3 months ago.
The 10-year yield is already at 4.77%. Yesterday, we were just below 4.7%. What do you think is happening in the bond market? Because you said it was falling apart, but what is the reason behind it?
Well, as I kind of tried to suggest before, the bond market was much more a believer in the recession story than the stock market was. That's why stocks did very well, and bonds were expecting big rate cuts, right, in 2024. When the Fed came out with the dot plot 2 weeks ago and reduced the number of rate cuts from 4 to 2, that signaled to the bond market that there's not likely to be a recession. So bonds had to reprice from expecting a recession, when obviously rates are going to be low, to taking out the recession call, and that took rates from whatever, it was like 415 to 450, right? And now they're having to price in a not just no recession, but a pretty good economic growth outlook. Again, ISM, manufacturing picking up, jobs openings, solid consumer. And so rates have now gone from 455 or 450 to, as you say, 475. I think when we spoke last week, I was saying that the next 25 or so basis point move was likely to be down. And that is obviously, that call is questionable at this point. But I think we're much closer to the end of at least this kind of bond panic, where, as I said, you have the most net short position in the Treasury market that we've seen in 15 years. And there are no buyers, because every day, if you're a buyer, if you bought yesterday in the Treasury market, you're already down. The other thing I want to make sure we talk about, or I mention, is that there's a lot of talk about big budget deficits in the U.S. and too much Treasury supply and not enough demand. That has not been proven in the Treasury auctions that we've seen over the last several weeks. What's called the bid to cover. So how many buyers are bidding for the supply, the new supply that the Treasury is offering? That bid to cover ratio has actually been quite strong. So that argument that people are freaked out about a budget deficit and therefore they don't want to buy Treasuries and there's too much supply, that argument doesn't really work either. So that supports my thesis, which is that we're in a bit of a mini bond panic and there are no buyers and you have shorter positions pressing the market down in price and yields up in the Treasury market.
You don't believe that the bond yield, so for example, the 10-year bond yield is going to go to 10% even? That's what some analysts and experts like Peter Schiff or Rick Santelli, CNBC editor, said yesterday. They said that even 13% was a possibility.
Yes, no, I saw that clip, and that gentleman is obviously getting a lot of attention. It's a well-timed, kind of argument, given that, as I said, things are dislocated, and therefore, in periods of dislocation, people are ready to believe almost anything, right? Because very few people thought we were going to be at 475. So now you talk about 10 or 13. Anything's possible. I would expect it to be extremely unlikely. We're not, inflation is coming down. And while we think inflation is going to settle in more around 3%, 2 to 3, it's not going to 5 or 7 or, whatever percent inflation you need to get to those kind of bond yield numbers. And then I also think that we need to remember that real interest rates. So what is the 10-year after inflation, right? Real interest rates today in the 10-year are 2.3%, give or take. And that is the highest, I think, since 2007. Again, same kind of last time we were in these kind of moves, which was right around the financial crisis. So we already have quite high, historically, real rates, and we have inflation coming down, disinflation. We're going to continue to see that because we know rents are going to cap the upside for inflation for at least the next 6 months or so. So I continue. I mean, it's been tough. I won't argue. The last couple of weeks have not been pleasant. But, we stick to our view that we are approaching a period of stability. We're going to have a pretty decent 2024 in terms of global economic growth. China's manufacturing PMI broke above 50 for the first time since, I think, January or February. So China, as we've talked about, we think China is going to be in much better shape than people think today. And the U.S. economy is probably going to grow around 2% next year. And that's going to be a good outcome in terms of earnings growth. And ultimately, for stocks, earnings growth is what matters, and earnings growth is going to be okay. And even in Europe, people have gotten very depressed about what's going on in Europe. We think we're closer to the end of the manufacturing slowdown in Europe than we are to the beginning, in part because we think China is going to pick up, and the data is going to be much more supportive coming out of China in the next 1, 3, and 6 months given that a year ago we were in the deep lockdown phase in China. So we're sticking to our guns, return to stability. We want to be overweight commodities and overweight equities. We're still deeply underweight fixed income. And as we have been for the last 2 years, we have virtually no U.S. Treasury exposure.
Advisory, thank you so much as always, and have a good day.
Okay, you too, Martha. Bye-bye.
Bueno, pues nos decía Jay Pelosky que ahora mismo